now is the time. That's the sort of spirit we're seeing out of Europe, from the company level right up to the policymaker level.
Causeway International Value Fund Sarah Ketterer is on Consuelo Mack WealthTrack.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Welcome to this edition of WealthTrack. I'm Consuelo Mack. As investors know all too well, the wisdom of portfolio diversification has been under assault for over a decade. U.S. markets have trounced international ones, and the superior profitability and performance of the Magnificent Seven big U.S. tech stocks was not the only reason. The U.S. economy itself has grown faster than other developed markets. Well, one of those trends has changed in recent months. Market leadership has shifted. So far this year, the U.S. stock market has lagged its overseas competitors, with emerging market stocks and European equities taking the lead. Why the change in market leadership, and does it have legs? This week's guest is a highly respected value manager known for her global and international investing. She is Sarah Ketterer, Chief Executive Officer of Causeway Capital Management, which she co-founded in 2001 and now has $55 billion in assets under management. She is portfolio manager for the firm's fundamental strategies, including 3 of Causeway's 5 mutual funds. Among them is the flagship Causeway International Value Fund. Launched in 2001, the gold-rated fund was singled out as one of the best international stock funds for 2024 by Morningstar. Ketterer and her team were named Morningstar's International Stock Fund Manager of the Year in 2017, having been nominated for the same honor in 2013. Ketterer is also a member of Barron's 100 Most Influential Women in U.S. Finance. I asked Ketterer to explain the surge in overseas markets.
Non-U.S. markets are a specialty of my colleagues and me at Causeway, and they're up strongly, like high single digits, give or take, but what's really moved them has been the currency strength we've seen outside the U.S., or if you want to think about it, dollar weakness. And one area that's especially attractive to investors now is Europe. Part of the attraction comes from the Trump administration's insistence that the Europeans spend more on their defense, on their security, on their infrastructure. And all that spending that is now going to happen, and potentially 5% of Eurozone GDP, it could be 750, 800 billion euros a year, will be stimulative. And knowing that that's coming, markets have already priced in some of it, which has moved foreign markets, in particular Europe, higher. And then again, this tailwind from currencies creating a really attractive return, one that we haven't seen in years, an enormous outperformance versus the US. And it likely will continue as long as there's still this potential for a turnaround in how Europe thinks about deploying its own savings rather than letting those savings leave the region and go to the US market, for example.
Sarah, that is such an interesting observation that Trump, who has been roundly criticized by trading partners all over the world for coming down so hard on the U.S.'s allies, that actually has stimulated economic activity in Europe and is a positive.
These are our allies, and we want them stronger. We don't want them to suffocate, or as Mario Draghi said, kind of a slow death of overregulation. There's so much potential in that part of the world. And Germany has the ability fiscally to spend demonstrably more than they've done so. They're not in hock up to their eyeballs like so many other countries, taking advantage of that. And now is the time. That's the sort of spirit we're seeing out of Europe, from the company level right up to the policymaker level.
You know, you mentioned Mario Draghi, and of course he was the former president of the European Central Bank. He authored a report for the European Union about the future of Europe, Europe's competitiveness. And he was very critical of Europe. A lot of times reports come and go, but is his report on European competitiveness being taken seriously, and do you think it's actually going to be implemented?
Yes, we do. It was serious when it was announced last fall, but with the Trump administration's insistence on Europe taking more responsibility for its own spending, its own defense, that might just be the catalyst. And the part of the European markets that's responded the most positively have been the financial institutions, particularly the banking stocks, because this will likely bring about much stronger lending. And Mario Draghi was all about that. It was like, how do we create public-private partnerships in order to get this money spent, in order to shore up Europe? And then his concepts were also deregulation and an end to the crazy fragmentation. I mean, in the EU, there are 27 countries, and oddly, they have to be unanimous on many subjects. Well, why not just a majority of the willing? These ideas, which I'm sure he had an incredible team working with him, but they make so much sense now, and the markets are running with that.
Forgive me for being skeptical, but it's one thing to say, yes, we're going to spend 5% of our GDP on defense. And it's another thing to actually enact it. I mean, the U.S. doesn't even spend 5% of its GDP on defense. We've got some work to do here as well. So what gives you the confidence that the money is actually going to go into the system and the money is going to be allocated and spent?
Well, every full percentage point increase is incredibly impactful. So we don't necessarily have to see it all up front. Likely this will begin sometime next year. But defense and security, so all kinds of security measures, they could be cyber related. So not all of this is tanks and ships. The definition of defense is pretty wide, pretty broad. But there's also infrastructure and transport. The energy infrastructure, for example, needs upgrades. We need to do the same because we're all short of the electricity we're going to need.
Grid.
Exactly. Doing this has all kinds of second order effects, ecosystems that are built up to support whatever has just been spent on. Like, this is why, from an investor perspective, it's so fascinating, because the obvious beneficiaries aren't just sort of defense companies. They're almost all companies. We're even looking at enterprise software, for example, as being a tremendous beneficiary. As companies are forced to accelerate the digitization and move to cloud in order to be able to take on the additional investment and deploy it.
Are these going to be government spending programs?
Some, but they're leveraging those government dollars, for example, through matching funds and grants.
Okay.
And these aren't new ideas, but they just haven't been done in Europe to the extent of the US. And maybe the single most powerful idea of all is a unified European Union capital market. Rather than, again, lots of fragmented pools of capital, one major deep pool of capital. That would be transformative for Europe, because not only would it attract back savings that have gone to other parts of the world or other places, but it would also be a way to ignite growth in young companies that heretofore might have gone to the US to seek out capital.
You've been a global value investor for a long time, just founded Causeway in 2001. Have you ever seen anything like this?
Well, the formation of the Eurozone was impressive, but I have to admit.
Was it as stimulative as far as the economies and the markets?
Well, the intent was, and as we know, it was always called the Eurozone project, which always makes me nervous because project sounds like something we're not sure is actually finished. And what didn't get completed was fiscal union. So we had monetary union. You mentioned the European Central Bank, the ECB, but the fiscal union never happened. And during the European bank crisis of 2012, and then even worse, during COVID, there was a lot of let's each country focus in on its own national situation. And there's some of that is appropriate, but a lot of it isn't, because it takes away from the benefit of being a Eurozone or even the greater EU, where working in unison creates tremendous scale. That's something that happens in the US. We have a single currency across all of our states. Although we've got differences in regulation across states, there's enough homogeneity to where companies can really grow nationwide. It's very hard for many companies to grow across Europe because it's so costly to manage around all the different regulatory requirements of each country. And just changing that or mitigating it would be huge for Europe. So to answer your original question, I actually think this might be bigger than the euro if it's executed the way Mario Draghi set out in the European competitiveness documents.
The promise of this has certainly been reflected in the financial markets in Europe. So Sarah, as a value investor, where are you seeing the biggest opportunities, and are there still values left after the appreciation that we've seen?
Yes, there are still values. If you think about the yawning gap, Consuelo, between where the U.S. market has been trading in valuation multiples versus non-U.S., well, it kept reaching historic highs, reached another one at the end of last year. You could drive a truck through that gap.
Yes.
We took notice and we told our clients, this is likely to close. It doesn't necessarily mean it'll close all the way, just that non-U.S. markets should be re-rated upward. And the U.S.'s valuation multiple re-rating that had been part of the U.S. outperformance might slow or diminish. And we've seen some of that. But what's the big move that has caused an outperformance of non-U.S. year to date has been currency. And that may very well be followed by more multiple rating upward for non-U.S. So we're bullish because there's still much more room to close that gap, or at least narrow it. And we won't close all the way because there's so many great U.S. companies. It's still the deepest, most liquid stock market in the world. But it did get a little silly, and as of the end of the last year, very, very silly. And that's what we like to see as value investors when there is an extreme and we can see only reasons for upside and very little for downside. We like that equation. That keeps risk contained. So paying so little, these multiples in the high single digits or low double digits of earnings for, say, many European companies at the end of last year versus twice that of US, a lot of things can go wrong in Europe and you still have a margin of safety.
And what about now, though? That was then.
The 8 or 9% local return before currency isn't enough to really change that significantly. We've just started to chip away. If I could show you the graph, it would be long 17 years of U.S. market outperformance, and now just a small blip upward in non-U.S. outperformance.
The Trump administration has made it a policy. They want a weaker dollar to make U.S. goods cheaper overseas. Is that the reason the dollar basically has been declining recently, or is it also the fact that the euro, for instance, is more attractive as well in its own right?
Well, what usually moves currencies is market expectations of changes in real growth rates and real interest rates. And with growth potentially picking up in Europe quite significantly with stimulative spending, and that alone makes the relative growth rates versus the US, it tips the scales perhaps toward Europe. And then that in turn will lead to higher rates because the cost of borrowing will go up as there's a greater demand for local capital. This just makes total sense that the currencies would move and shift in favor. But as I noted earlier, on a trade-weighted basis, the US dollar is back to what it was a few years ago. It's not as if it has had some sort of collapse. It just got maybe just a bit too strong.
So there's sectors that are going to benefit the most. I mean, we mentioned defense, and the numbers are pretty impressive of the kind of spending that is going to have to be done in Europe to meet the pledge that basically NATO members met of spending 5% of GDP on defense, at least. European defense stocks have done extremely well recently. So is that an area that you invested in, that you're still investing in?
The European defense stocks started moving before Donald Trump was even reelected. This is one of the extraordinary characteristics of stock markets is they discount news long before the news is even news. That makes the investor, as we are at Causeway, have to decide what the future will bring and then position for that. We've had a very large weight in a UK-listed company that operates globally. This is the predominantly commercial aircraft engine manufacturer, Rolls-Royce. They have a defense business, and they do get contracts from the UK. But as my colleagues have explained to me, it's not the defense business that's moving the stock. It doesn't hurt. But it's the problems that Boeing has had and the fact that older aircraft with engines that need maintenance have been coming in for service. And all that maintenance is incredibly lucrative for Rolls because these maintenance contracts, these airplanes that should have been retired are still flying, and thus the cash is coming in the door apace. And of course, investors love this because this is a company that a few years ago was struggling and now may be returning considerable amounts of capital to shareholders as they've completely restructured their balance sheet. So it's not directly defense, but it certainly helped.
And that's one of your largest holdings.
It is.
Where are you seeing opportunities that maybe the market hasn't fully discounted yet?
The Trump administration is still brandishing its sword, and one area of sectoral tariffs is pharmaceuticals. And it's not just the tariff threat, but it's also this concept that U.S. shouldn't be paying for a drug more than other countries, or what's called most favored nation. So many other countries, most in fact, have government pay, and they very strictly limit the price of pharmaceuticals, often at prices that don't really create a return for the pharmaceutical company that's adequate to inspire more research and development and innovation. So a lot of these pharmaceutical stocks, this concern about what the Trump administration will do is weighing on their share prices. And yet, they're some of the best businesses in our portfolio long term. Companies like AstraZeneca in the UK or Roche listed in Switzerland, again, they're global and they have good 20 to 25% of the revenues in North America, predominantly the US. They're world class in what they do. And yet, their valuations have slumped, markets are concerned. What we see are well-managed healthcare companies that are in the forefront of diagnostics, of oncology. They just dominate their fields. They're very innovative, and they will find a way to charge for their drugs that they can distinguish from the competition. And they don't trade at crazy high growth multiples. They're very inexpensive, trading it to mid-teens, sometimes less, PE multiples. So the market has given them the I'm concerned label, and yet there's so much income from these stocks. They have attractive balance sheets. They make very judicious acquisitions to bolster their pipelines with great biotech firms, and they pay serious dividends. And that income compounds over time, and it gives our clients who are investing in portfolios that have these stocks, they're getting paid to wait. I've seen this through my very long career, how important it is that companies return some capital to shareholders right away. And that helps to smooth the total return, so you aren't waiting just entirely for capital gains.
I know you get very excited about the companies that you're investing in, and certainly the prospects that you're seeing in Europe in particular. I'm thinking, as far as the pharmaceutical companies are concerned, that you're correct in that most other governments have single-payer health care, and they have the clout to basically negotiate whatever price they are willing to pay to these pharmaceutical companies. And until now, the U.S. has been a much more competitive market, not as regulated. So therefore, the drug companies have been able to charge much higher prices to the U.S. But it strikes me that time is running out, that in fact the pressure from both parties in this country is on to regulate drug prices.
The relief valve is there has to be a quid pro quo. If there's more regulation of drug prices, which will be through what the government pays for, Medicare and Medicaid, then there has to be some sort of regulatory relief when it comes to the huge, actually exorbitant cost of getting a drug from concept right to launch, and particularly these later trials that require so many patients that are ultra expensive. Some of that cost will come down naturally with the implementation of more artificial intelligence in the whole process, and some of it is government related, and relief could be sought there. So we're optimistic that profit margins can largely be maintained for these drug companies. The key is they keep innovating, because then they're in the driver's seat, just like any company when it comes to pricing. If you have something unique that everybody wants, you name your price. Meanwhile, the Trump administration would very much like non-US countries to pay more, and the president has said so for the same drugs that we have, for example, in the US. We'll see if that happens.
I was going to say good luck with that. You mentioned the fact that the financials have really responded very positively to the prospects of much more spending on defense and on everything else in Europe. I know that Barclays is one of your largest holdings. Which financial institutions do you think still stand to benefit the most that are, again, from a value investor point of view, are relatively attractive?
Well, you mentioned Barclays, and we think their ability to continue to increase the returns on capital is quite astonishing. They had a really difficult time up till about 3 years ago, and now the rewards are coming to shareholders. Also, Germany's largest bank, Deutsche Bank, is very interesting. Despite having a really strong return year to date in the latest 12 months, it was the laggard amongst the European banks, having suffered from all kinds of scandals. It's extremely well managed now and cleaned up their act and focused and benefiting and likely to benefit more as this stimulus takes hold next year and years hence.
One investment for a long-term diversified portfolio. Sarah, what would you have us all own some of in a diversified portfolio?
Stock I mentioned earlier, AstraZeneca, this UK pharmaceutical, again operating globally. While we're unfortunately harming, at least for now, the R&D efforts within US universities, that's not happening in the best universities in the UK, like Cambridge and Oxford. And so this is great for Astra because they have a real connection there. They may end up getting these innovations that just are slower in the US because we're starving of capital, the basic research needed to go from academia into the world of commercialization. Why own volatility when you can own a great cash generative business that grows and isn't very expensive? I love it, and the dividend too.
The level of enthusiasm that you are exhibiting right now about the opportunities that are ahead of us in Europe are very inspiring and very exciting as well. So thanks very much for joining us and sharing some of your thoughts with us. It's really been enlightening.
Thank you, Consuelo.
At the close of every Wealth Track, we usually give you one suggestion to help you build and protect your wealth over the long term. This week, we are changing that approach and asking Sarah Ketterer for the best investment advice she has ever received and what she would advise now. This week's action point is diversify portfolio risk.
This is not going to surprise you, Consuelo, but it's diversify. Stay diversified. But let me add a twist to that. It's not just having X number of holdings. You can over-diversify, end up looking like the index. It's understanding the idiosyncratic or company-specific risk that's in the portfolio. If it's, let's say, Nintendo, the Japanese video game company, and they haven't had any new products lately, your company-specific risk is they won't have another new product and then the share price will fall. But there's also another layer of risk. It's called market risk or systematic risk. And understanding to what degree in the portfolio you have, at least of your equity investments, where is the cyclicality risk? How much size risk do you have? What about volatility risk? Is there value risk? Is there growth risk? And we have a nice tool internally at Causeway to help parse that out, making sure that both those company-specific risk, and you can diversify a lot of those away, but the market risk can't be. And knowing what those are, an example would be we sailed right into the pandemic in early 2020 with too much cyclicality risk. And unfortunately, economies nearly ground to a halt and everything stopped briefly and the cyclical stocks were horrible. And we knew we had a lot of cyclicality risk, but if you're going to concentrate, you should better be ready for the consequences.
And what would your advice be to an investor today? So that was the best piece of investment advice that you were given, but is that the one that you would pass on to us as well?
I would add, diversify with discipline. This is the hardest for people because there's nothing more exciting than having a stock or a whole set of stocks in your portfolio. Maybe it's everything you own. It could be your other assets. When they start to run and you have exceeded the allocation you set out, that important asset allocation, how much do you want in fixed income or equities or alternatives, whatever asset classes that are important to you as an investor, if you are no longer at that allocation and revisiting about every 6 months seems about right, you need to get back to the allocation, and that requires discipline. People hate to sell their winners. They're just psychologically, it's so hard, but it's so important.
The late great financial historian and risk expert Peter Bernstein, who wrote the classic Against the Gods, The Remarkable Story of Risk, always told us you are not truly diversified until you own something you are uncomfortable with. That definitely takes discipline. Next week, we sit down with Sempervic Partners Tom Russo to discuss his concentrated portfolio of global consumer brand name companies. How are they being affected by this new era of economic and geopolitical disruption? Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a relaxing weekend and make the week ahead a healthy, profitable, and productive one.